Good morning, good afternoon, and for someone, good evening. Well, welcome to our Solarplaza webinar. My name is Anna, and I'm the project manager at Solarplaza. So today, we'll be exploring an important conversation on how the solar and storage industries are preparing to the challenges and opportunities ahead. With the passage of the One Big Beautiful Bill Act earlier this summer, many of the incentives and timelines that shaped our industry under the Inflation Reduction Act are shifting. So, of course, for developers, investors, and other stakeholders, that means new deadlines, new risks, and also new strategies for staying competitive. That's exactly what today we will be talking about, what this panel will focus on. So how to secure solar and storage projects before and beyond 2026, while keeping an eye on compliance, trade dynamics, and long-term resilience. So thank you so much for joining. I hope you settle in and we can kick it off. I'll give a bit of an introduction also to those who joining us for the first time about our company. So just to give you briefly our background information, so Solarplaza is a Dutch-based company and platform that specializes in solar and storage events with a deep focus on knowledge sharing and networking. Some of you who attended our events, you guys know that we really like when you are connecting with each other. We always voting for it. So over the past 20 years, I think we've hosted more than 250 events in all kinds of countries and all continents. And we try to connect more than thousands of professionals across the globe. And this webinar is actually part of our content pieces that are leading up to our two conferences. I'll mention them in the end of this webinar. There will be also a sweet treat for you to access those conferences if you're interested. We're always happy to meet you in person. But let's shift our focus a little bit to something else now. About the agenda for today, so a short introduction at the moment, which is already ongoing. So I'll also give you briefly some practical information a little bit later, but also we will go through the actual main panel discussion with our esteemed speakers, with the moderator, followed by the audience Q&A. So please feel free to drop your questions throughout the discussion. I'll explain to you how can you do it in a moment. And then finally, I'll share some information in the end on some upcoming events. So if we move into the practical information, you can see in your right top corner, you see their box, a little Q&A box. That's where you can drop your questions. So please use that box not only in the end when we have a general Q&A, but feel free to use it at any point. If you have any questions, we'll cover them as much as possible in the end of the panel. And also, if you have any technical issues, you can't hear us, or something going on that you are unclear about, please feel free to use the support tech issue box. We can also answer you to that one, so don't worry. So I'm not going to take too much of your time. I'm going to ask Richard now to turn on the camera, and I think it's a good time to begin now. And I'll hand over to you, Richard, to do the introduction. I would love to hear a little bit also about yourself, to share it with the audience. I'm pretty sure a lot of people already know you as well as a lot of our specialists today. So yeah, please go ahead. We also will have a little disclaimer during the introduction, so please pay attention as well. But Richard, over to you.
Thank you so much, Shen. Well, good morning and welcome, everyone. So over the next 45 minutes, as Anna described, the goal is to tackle the most critical issue that's facing our industry right now, right? How do you get these solar and storage projects done before and beyond 2026? And so we're going to break the conversation up into two parts. First, we're going to spend about half the discussion on the immediate challenge, right? How do you understand and navigate the deadlines that are coming up here? Next, we're going to pivot to the commercial and technology strategies that are going to define what the industry is going to be doing next. And of course, we're going to carve out the last 15 minutes for Q&A. So of course, feel free to feed that into the chat when you come up with one. So briefly on myself, I've been in solar since 2007, so almost 20 years. I started off the manufacturing side, was the founder CEO of KWH Analytics, so an insurance company for our space, and then most recently at the U.S. Department of Energy under the Biden administration. So let's welcome our expert panel, and you guys feel free to turn on your cameras when you get this. So first would be Jenny Speck, who's a tax partner at Vincent & Elkins. Next, we have Phil Shen, who is a managing director and equity research analyst at Roth Capital Partners. And last but not least, we have Emma Conant, who's a CTO and co-founder of Tierra Climate. So we'll start in a second, but first, of course, we've got, I'll turn it over to Phil because we've got some necessary disclosures to get through. Phil, over to you.
Great. Thank you, Richard. Thanks for the disclosures. I work at Roth Capital Partners, which is a boutique investment bank. I've been covering solar for 15 years, and I do it from the perspective of equity research. And so I follow the critical factors that drive solar stocks higher and lower, and there's a nice overlap with those factors because a lot of times they matter to the industry as well. And so happy to looking forward to this discussion and conversation about what might happen ahead. Thanks.
Okay. All right. Well, so let's dive into part one here. So of course I'd be remiss if I didn't first tag in our attorney here. So for Jenny, let's get into it. Like for everyone in the audience, maybe the highest level question here: what are folks coming to you asking questions about nowadays?
Yeah, I'd say the biggest question is how do I start construction so that I can qualify for these tax credits? And as everyone understands, the One Big Beautiful Bill had certain changes to the clean energy investment tax credit, which if you start construction, a tax technical term, after January 1st of 2025, you're automatically in this new Section 48 CAFE clean electricity investment tax credit. However, how you start construction now depends on your technology type. Previously, we had long dated guidance on what it meant to start construction. The industry and market were very comfortable. There's two methods to start construction. But as of August 15th, if you are solar or wind technology for the clean electricity investment tax credit that you're trying to qualify for, you can no longer use the 5% safe harbor methodology. So mainly, Richard, what you're alluding to is we're getting a lot of telephone calls. How do we start construction under the physical work test? Especially if we are planning on doing solar and battery storage co-located energy properties. So that's probably the biggest question. And then how do we document that we started construction is largely the second question.
No, that's very helpful. When you think about those questions that are coming in, like, are there best practices that come quickly to mind that, of course, we can preview some of these buckets at a high level and we can return to them in Q&A.
Yeah, I think understanding where the market has evolved from in terms of getting comfortable with physical work tests is something to think about. If you go back to the COVID days, that's largely when we saw a shift from most developer sponsors, pursuing a 5% safe harbor to now pursuing a physical work test. And then the stakeholders in the market had to follow along. So they had to get comfortable with that. So we've seen physical work tests, I would say predominantly this year. We already saw physical work tests prevailing for most projects, that being the preferred way of starting construction. The biggest question that you have to ask is, am I documenting it right? If you're going to start construction under physical work without getting into the weeds and boring everyone with the technicalities, you either have to do it directly. You're the one out there performing physical work on an integral component, whether it's on site, or you could do it on your behalf. So you have a manufacturer performing work on your behalf, or maybe an EPC who's on site performing work on your behalf. It's how are you documenting those contracts so that those contracts qualify? How are you documenting the work that took place? What type of work took place? How much work took place? Because although the guidance is very clear that there's not a monetary threshold that signifies you've started physical work, it looks to the type of work and whether it's significant on an integral component. You need to understand that the market participants, if you're planning on selling your tax credits, if you need project financing, potentially investors coming in down the road, you need to understand that they might have a higher level that they're looking for in terms of the amount of work performed than what would typically be required if it were just, a taxpayer who's performing this work, claiming the credits on themselves, no third parties coming in to diligence their project. You might be looking at different standards per se.
It's a great point. Actually, I've not heard that one come up yet. It's like the entire industry needing to adopt to this new standard means that there's going to be several definitions of that standard that we're all going to try to converge on quickly in the next 3.5 months, which is going to be very interesting.
Yep, that's a good point.
Wow. Okay. Well, here, let me hand the mic over to Phil. So Phil, I know your research coverage covers both like the manufacturing side and of course like the IPP side. So maybe starting at the very high level here, given both like the legislation that was passed as well as some of the guidance that's coming in, like how are you seeing that impact some of your coverage landscape?
So I think the stocks in general have reacted favorably. They were investors were bracing for more negativity, and specifically the risk of retroactivity, rendering with the new guidance that came out, rendering potential prior safe harbor module projects, you know, what's the right word, in a difficult, or putting them in a difficult situation. And so now with this guidance, it came in much better than expected. So the stocks have done relatively well, and it's been a clearing event, if you will. Kind of speaking to what Jenny was addressing earlier. So documentation is part of it, but I also believe that the tax equity investors are a key group that needs to adjust. They're in the process of adjusting, and what they deem as acceptable as physical work is also super important. So, you have the physical work test, and a lot of people were using transformers as the foundation for that. Now, how much more do you need to do? And so, we hosted a webinar with Keith Martin actually a couple days after the guidance came out, and he basically said, the tax equity investors are going to establish new standards for significant physical work. So I'd be curious, Jenny or Emma, have you guys heard of what those new standards might be?
I can just say from being in this industry for a long time, understanding that we already have standards in place. We represent a lot of tax equity investors, and I have not heard them trying to change that standard just based on this recent IRS notice guidance. They already had standards in place for physical work. Like I said, we saw a predominant shift to a lot of physical work projects that were safe harbored in the COVID era. And so I don't understand a rationale to see a new standard. Now, that doesn't mean to say that these new projects aren't going to have other issues, because under the One Big Beautiful Bill, you have the new prohibited foreign entity issues, right? So there could be other standards that come into play. But when it comes to starting construction under the physical work test, I don't see us having an additional standard created now that we've not already had to face in the industry.
I guess the question is, will transformer components, buying that be enough, and so.
That's a good question, Philip. So we actually have a lot of clients who are, entering into agreements to buy transformer components, but I think you have to ask yourself what component will be manufactured by year end, how many components, how many man hours went into manufacturing those components. It is a multi-level faceted review. It's not just a simple, I entered into this agreement, they performed 5 hours physical work. I think you could probably ask most tax lawyers and they would not get comfortable with that being considered significant if it was nearly 5 hours. But there's a certain amount of man hours that typically, based on our experience, again, with working with tax equity investors, that we know certain investors have already gotten comfortable with. And that's what we try to guide our sponsors into following, understanding here's what the market has established as getting comfortable with physical work. I think there's a best practices of having multiple work streams ongoing. So even though you've executed your transformer agreement and perhaps they're going to start fabricating the radiator components by end of year, how many of those components are they going to start fabricating? Go ahead and think what's next. What other custom item could you enter into a binding written contract and start fabrication so you have overlapping work streams? Because if something were to happen to those radiator components that were fabricated by end of year and they weren't ultimately incorporated into your qualified facility in a year or two, you don't have a safe harbor for 2025. And so I always tell clients, even without this guidance, having overlapping work streams is the safest strategy, kind of a belt and suspenders approach. If you can mobilize on site and start excavating the foundations and pouring the foundations, something that you can show that you've started additional physical work, that only strengthens your case, right? And as I mentioned at the outset, depending on your stakeholders involved, you're going to need to show a stronger case for some than others who might be risk adverse, or some who are more, they take on risk. It really is dependent upon that, I would say.
So I need to, of course, call out for sponsors to notice that there was at least one attorney out there who's advocated against something that was going to create more billable hours for the legal industry. Okay, so maybe to wrap up this first section of the conversation here, what are we seeing in terms of how the market's reacting to this, right? What are some of like the shifts that are going on as the industry attempts to adapt to what's clearly become a bit of a timeline here?
Is that towards me or Philip?
To the group, I would say, but yeah, I would imagine both of you have that viewpoint there.
Philip, do you want to go first and I'll answer second?
I'm still reflecting on the question, so if you want to jump and go ahead first, that'd be great.
I think it depends, Richard, in terms of the supply chain, I think is what the market's having to adapt to currently. The prohibited foreign entity rules that require you not to, regarding material assistance, right, requiring you to not, procure items that would be from a prohibited entity from material assistance standpoint. Those kick in January 1st of 2026. So we're seeing a big influx of how do we avoid the material assistance prohibited entity rules by starting construction by end of the year. If you're going to have solar or wind technologies, if you are solely a standalone battery storage, one thing I want you to take away is the guidance that came out in August doesn't apply to you. It doesn't apply to any other technology but solar and wind. So for battery storage, you are safe to use 5% safe harbor. You are safe to use physical work test. You don't have to be placed in service by 2027. So I don't want that to be the takeaway. Only solar and wind has those higher scrutinized thresholds that they have to meet.
Yeah, what we've heard from developers is a really intense focus on Fiak. And so, a lot of suppliers, module vendors are promising compliance and all these different things. But, we have REPlus coming up in a week here, and that, we published a preview of what people are interested in figuring out while they're there. And that's a key question. So that's how people are trying to adapt to this new guidance and the new law. And we don't have the Fiak standards yet. And so, or at least the guidance, right? We're thinking maybe a notice could come out later this year, but then the final guidance might be 9 to 12 months from now. Jenny, does that resonate with you at all?
Yeah, we have heard that obviously Fiak, since it is intertwined with almost every tax credit that was modified, we are hearing that it's a priority. There's going to be guidance soon. I think, Philip, you're right in terms of we should see some guidance by year end because it is applicable starting for the taxable years that begin after the enactment of the OBBB, however many B's we've got there, for at least the prohibited entity, specified foreign entity concern, and also the foreign entity of influence issues that you have to also analyze. So I do agree with you. We need guidance because it's going to be applicable really soon. But you're right in terms of how long it takes to typically get proposed and final regulations out. That is a lengthy process.
Thanks, guys. All right, so let me shift this into the post-2026 realm. So Emma, when you think about the world that we're entering into, like how are you seeing the business models shift for these ESS players?
Yeah, it's a good question. And Richard, I apologize if my connection's a little unstable. I've been having some trouble this webinar, so hopefully this is coming through. But yeah, I mean, I think for energy storage, things have really changed even over the past couple years. I think in every market where energy storage is starting to become a big player, largely Texas and California, but in some New England states as well. A large portion of the revenue stack has been from ancillary services, which are very small markets compared to the energy markets. And the issue is that as we build more energy storage, these markets become saturated and there's price suppression. And that means that energy storage has to look at other places to diversifying their revenue streams. And I think a lot of the bets that are on the table right now for folks who are deploying energy storage is on actually just capturing real-time energy volatility and really just getting paid through what we call energy arbitrage, buy low, sell high. But I think increasingly, especially in, like this past summer in ERCOT, it's been a very, very mild summer, very, very poor performance for the energy storage fleet and just generally for the generation fleet. It's been a tough summer to make money. I think folks are looking for offtake from voluntary buyers. So folks who are interested in contracting for energy storage or for solar plus storage to either make environmental claims or to hedge the renewable portfolio. And increasingly for energy storage to look at monetizing environmental attributes. So whether that means, moving towards a 24/7 hourly shifting, supplying RECs around the clock type of a world, or whether that means just actually quantifying kind of the greenhouse gas reductions that you can achieve by deploying energy storage in any given market. And I think that that's what we'll start to see for energy storage, whether that be paired or standalone on a go-forward basis, is a look to open up more revenue streams besides just the classic ancillary heavy strategy, and then relying on the very small moments where you get high volatility in energy arbitrage.
That's great. Perhaps like a follow-on there. So that's a great dev IPP sort of perspective. Maybe Phil, do you see anything on your coverage universe with regards to how OEMs might be reacting to this?
Well, there's a lot of things coming up that makes the landscape a little bit challenging right now. We just published this morning that lithium was recently added to the UFLPA high priority list.
Wow.
And so so there's the reaction to the OBBBA, and then there's, potentially, there's just so many things that are happening, right? You have all the tariffs. And so we followed this very closely for solar back in 21 and 2 and 3 in terms of detentions and the process. I got to imagine that this might be putting storage developers and asset owners in a challenged situation, or just raising anxiety, because once you get detained, you have to find and diversify your supply chain, and people should have been already, but you don't. It's not here until it's here, and then people have to race to really get it done. So I'd be curious if Emma or Jenny or others have you guys seen that yet? This was added to the list August 19th, and then how might the industry be reacting to this?
Speaking of myself personally, it's the first I've heard of that, Phil. It's I didn't realize it's yet another thing that's getting added to the stack of legal bills. Put it that way. Go ahead, Emma.
Yeah, I mean, I think the lithium constraint is a problem regardless of, there's a supply chain issue with relying on lithium, and that's kind of the thing that we're building right now. Most batteries that we're building are some form of lithium ion. I think we work with a lot of developers that are exploring other technologies, but the largest challenge from a wholesale markets perspective is the round trip energy efficiency. Frankly, a lot of different types of technologies for batteries just don't have a high enough round trip energy efficiency to get the kind of returns in the wholesale market that you need. Obviously, if you have to buy 100 megawatt hours and to sell 50, that's very different from being able to buy 100 to sell 85. And so, yeah, I think we just have been struggling to see new technologies break ground just purely because it's very difficult to get them to pencil based on that fact alone. And that's just a little bit of a technology barrier to entry until we start to see these round trip energy efficiencies get higher at these other technologies. Or if we start to see the energy arbitrage opportunity widen out, that's another thing that, will enable these technologies that have lower round trip energy efficiencies. But yeah, I think it's just another barrier maybe, and it's going to squeeze the market a bit as lithium is kind of like the only thing that's really getting built at scale in these markets right now.
Yeah, I agree with that. That makes sense.
Perhaps maybe I've got time for one or two more questions before we turn into audience Q&A. Phil, as you were talking, it made me realize that, going back to this theme on the merchant piece, if you had two yieldcos in today's market, so one called classic yieldco, all contracted cash flows, etc. I think we saw with, was it Calpine did a take private, but I'm just imagining, is there a scenario where if, let's say, an intersect power type player that has a meaningful merchant exposure were to hit the public markets, does that actually become more attractive to a public equity investor perhaps than like the classic yieldco model? Or look, this is just not something that the market's ready to even exchange at this point?
I think it's more the latter. There's been this trend, and you just highlighted the Calpine sale of the IPPs kind of going more private. And so I think they're, why are they doing that? It's because the public markets are not rewarding them. And so at this stage in the cycle, if you will, we're probably going to see more of that, as a theme. And when valuations become more attractive, maybe the merchant curve is more highly valued, then we might see that flip back around. But it's the latter point that you mentioned there, Richard.
Okay. No, thanks for the take there, Phil. All right. So last question before I turn over to Q&A. It's more like what does the audience not know that you guys are seeing, like they should be paying attention to, right? Like what technology, what policy, what market shift, like what's not getting enough attention today but if you were a developer IPP, you really think that they should be thinking about this more actively?
I can go for first. There have been so many gotchas that have come around the corner, and there can be more. And so we have the Section 232. That's the poly trade tariff that's in process right now. I think a lot of people are not fully aware of what that might mean, and that is a process that does not have much visibility, because the White House can just basically do that all internally. And the comment period is basically now, meaning now's the time to lobby the White House, if you can, to try to influence it in the way that you want. But that's very difficult, right? And the timeline's quick, and the structures that I'm hearing are pretty dramatic in terms of what it might mean with tariffs. So there was a framework that the Coalition for a Prosperous America put out there, which is basically, if there's poly in the module, from a module imported into the U.S., it could be 20 cents for the module, right, per watt. It could be 10 cents a watt for the cell, 7 cents for the ingot or wafer, and then $10 per kilogram if you import poly. Not too much. Anyway, so the point here is that is all, and those things stack on top of all the other tariffs that you have. So just you're navigating the Fiak thing. You got the 232. We just had Solar 3, which is the AD/CVD on the 4 countries in Southeast Asia. Actually, Solar 4 just got filed. So Solar 3 was April 24. Solar 4 was just a couple months ago. That was Indonesia, Laos, and India. I mean, it's just a gauntlet of challenges. And so by U.S., I think is the safest play.
It's a quick observation there is that one of the high-level takeaways for me from my time at DOE was just how much this country has both an accelerator and like a handbrake on for this industry. Right, it's like even as you're, of course, describing those lists of tariffs coming in from manufactured inputs, obviously there's a bipartisan intent to increase the level of manufacturing that's happening in this country. And so the idea that we could be incentivizing on one hand like an X cents per watt for a wafer speed manufacturer, at the same time putting like a tariffs on ingots, it's a tough industry for any of us to be involved with.
Yeah.
Jenny,
so let me clarify what I just said. So buying U.S. maybe, as opposed to being so affirmative, right, or deterministic, maybe one of the safer paths, right? And so there are many paths. And one thing we've heard from our resi solar industry contacts, and this might be more utility scale solar, but there's a play right now where they're trying to avoid, like there's a supply chain called the domestic content buster supply chain. So they're trying to buy everything from outside the U.S. and basically saying we're going to avoid the ITC and all that. We don't even need the ITC. And so there are a lot of different things that are happening right now. But if you want the ITC, a safe way might be to buy more non-Fiat. And so, that's what OBBBA was encouraging anyway. So I'll pause there. I know I spoke a lot. Thanks.
No. Yeah, we could go much deeper on that one. But Jenny, I'll hand the mic over to you. Oh, sorry, Jenny. Do you have a thought there?
Sorry, the webinar had froze momentarily. My thoughts are, echo what you and Philip both said. It's really hard to completely predict the future here. We are living in a slightly unpredictable landscape in terms of the tariffs and different changes. And so surrounding yourself, attending these conferences with smart advisors, making sure you don't know what you don't know. And so tuning in and making sure you're hearing weekly, monthly, what are the updates? What are others hearing? What's keeping people up at night? I think is really smart. I don't think that you should be deterred from building currently. Like I said, we have a lot of clients are just moving straight ahead and making sure they qualify. And real quick to Philip's point on Buy America, yes, right now it seems definitely safest to buy America, but the hardest part is proving, did you buy America, right? How do you make sure you understand the supply chain upstream, where these subcomponents came from? Are those truly Buy America components as well? And so documentation, record keeping, making sure you have third parties reviewing everything and helping you tick and tie to ensure you qualify for those credits at the end of the day is really key.
All right. Well, Emma, last word from you before we go to audience questions.
Yeah, I mean, I think just in terms of things that, folks could be looking at is like a lot of this conversation has been focused on the tax credit side. How do you reduce the cost to build? How do you, hedge against the volatility and the risk there? But the other side of the equation is the revenue side. And I think for energy storage specifically, a lot of folks have built projects merchant with the expectation that they would be able to contract later. And I think folks are coming to the realization that the revenues are very volatile for energy storage. Like you could get, 75% of your annual revenue in one day in the year. And that becomes very difficult to leverage and to put debt on these projects. And so I think, one call to action I would say is like a lot of what's driven the build out for wind and solar has been the PPA market, which is driven by voluntary corporate procurement. And I think that we'll continue to see that for energy storage, but that's going to be largely guided by the changes to the greenhouse gas protocol, which governs how companies report their emissions. And that's being revised for Scope 2 for the first time in a decade. And the comment period is opening in October of this year. So, that's really gonna change how companies are looking at, providing offtake to wind, solar storage, solar plus storage, and could actually create an opportunity to stabilize cash flows for these projects, to help get more leverage on these projects, and also to increase the revenue by monetizing an attribute that has thus far not been able to be monetized, and that's the environmental aspect of energy storage operations.
That's great. Yeah, I don't think there's been much discussion around the fact that Scope 2 is getting revisited. So it's a really big deal, but so far upstream for many of us that we may not be paying attention to it. Okay, well, with that, we have a number of audience Q&A here. So I'm going to start us off with the highest level one, which is that, okay, so put yourself in the shoes of a dev IPP. You've got your pipeline of projects, 2025 to 2027 CODs. What are the biggest bottleneck that you think that they should be worried about, given this 40,000-foot view you guys have, either as an attorney looking at a number of projects, software looking at a number of projects, Phil, of course, from the public equity standpoint, what do you worry about as being the biggest bottleneck if you're worried about your dev pipeline?
I think it has a lot to do with permitting, construction delays, things of that nature, making sure you have your supply chain lined up. You could have your development pipeline laid out. Everything never goes to plan though, right? And so making sure you have a plan B for those delays, and any stakeholders that you plan on coming along for the ride, being well informed and everyone's fully understanding where you truly are at for your COD date. That lines up well with when are you actually going to have revenue? When are you going to be able to sell your tax credits? You need to really make sure you understand the true COD dates for your pipeline.
Yeah. So Richard, I'll kind of answer this question, but also answer your prior question about future things that people are not thinking about. I mentioned UFLPA, but we've published also that for storage. We've also published recently that more and stronger UFLPA enforcement for solar is ahead. And so we've seen already some enforcement, right? Recently, I think Q-Cells or Hanwha got tagged, but that's even before what one of my contacts said, the crazy that might happen with UFLPA, because a lot of the Republicans did not appreciate the way the Biden administration was enforcing UFLPA. They thought it could have been more aggressive, and Marco Rubio was a key driver of UFLPA, and now he's in the White House, and so they are staffing up CBP, and they are it's going to take time for them to do that, and so it's in 6 to 12 months is the timeline that we've been given. There could be another step change higher in terms of what that enforcement could be, and so it's batteries, it's also solar, and how do you prepare for that? I mean, that's very difficult, right? And so just maybe having optionality in the way you do business is probably the best that you can do. If not, working with, again, like I said earlier, more American suppliers.
Oh, this is great, and I think this dovetails well into another question that was asked, but just to ask it and then preview the fact that some of the answers are already coming out. So the question was, given the hodgepodge of risks that are coming down the pipeline here, right, from like procurement challenges to legal challenges to market challenges, advice for developers who are trying to get their projects done. And so, what you were just describing around Jenny was describing having an option B. Phil, I think you're saying just like optionality in general is just important when you're faced with just a ton of uncertainty. Is there other advice that comes to mind that you'd be communicating to a developer trying to get things done?
Just echoing what Jenny said earlier, which is, you have your day job, but then you have to follow what's going on in DC and throughout the country. It's just really difficult. And so just staying on your toes and spending that time to try to have some peripheral vision is important. And, if feel free to reach out to me if I can be helpful, please do.
Sounds good. Well, Emma, I'll pivot to a question that was ESS specific. So the question was on revenue stacking, right? So you already pointed out that there might be some environmental attributes that may be less considered that perhaps will be coming into the fore. Like, can you just describe just like how you see that landscape evolving, and where would you prioritize if you're a developer in ESS?
Yeah, so I think for developers, it's becoming increasingly challenging to just rely on merchant energy to get projects to pencil and to honestly just manage the exposure. A lot of these projects are currently equity financed, and when your revenues are so volatile, it's very difficult to leverage these projects unless you find offtake. I do think that there is appetite at this point from various different hedge funds that are looking to actually wear risk in power markets. And as we see, increasing amounts of data center load come to market, and we see increasing challenges to building generation infrastructure, like there's a very bullish story to be told. But that bullishness does not come without volatility. And so I think it's difficult for developers to wear that volatility. But there are players in the market who are looking to contract for that volatility. And so I think thinking about offtake opportunities, whether that's a full toll opportunity or some sort of revenue share or some sort of revenue floor, is really helpful. And then I also think that, we discussed briefly about the greenhouse gas protocol changes and that landscape changing. And I think that that's going to increasingly push corporates to either procuring dispatchable capacity directly because they can't connect their load unless they bring dispatchable capacity to market. You can get that through contracting with storage. Or talking about meeting, 2030 or 2040 environmental goals like net zero by 2030. Like that's not going to happen without energy storage. And so I think that that's another contracting opportunity that you can basically find someone who has this willingness to pay and willingness to wear the risk that can expand the pie of revenue opportunities because someone's willing to pay for an environmental attribute that this battery is able to monetize. That can really help. And then, capacity markets, of course, Texas obviously doesn't have a capacity market. So it's one of the biggest battery markets in the country. But in California, procurement requirements, requiring utilities to procure a specific amount of, dispatchable capacity in their annual procurement plans will push capacity prices up. And I think we can probably expect to see that across the board. As we get squeezed with more load and more variable generation, there will be more value on dispatchable capacity, which storage can monetize.
That makes sense. Maybe I'll tee up for the audience that I could probably take one more question after this current one. So of course, feel free to fire away there. Maybe Emma, building on that, I know that of course the hedge funds have been omnipresent in this industry, right? Before any of us renewables guys got to the scene. I do feel like historically the challenge around that was the products coming out of the hedge fund community we're not necessarily enabling more efficient capital structures from the project side. Has there been something that's changed there that is enabling some fundamental changes to capital structure, or is it simply just an equity hedging strategy that's being employed here?
Yeah, I think it's a very nascent market, and I'm not actually sure that we've seen much of this transact.
Okay.
I think that we're just starting to see kind of the appetite to where the risk kind of extend maybe more into the physical space rather than just purely on the financial side for these hedge funds. Of course, they're not investment grade, most of them, so that is difficult when you talk about credit. But I think that there are ways around that. There are ways to, post letters of credit. There are ways to for these kind of alternative players to step in and actually provide the offtake that, frankly, I think lenders are just looking for stable cash flows. And I think any offtake, even if it's not necessarily from an investment grade counterparty, can help with that. And I think at this point, storage is really scrambling to look for ways to stabilize those cash flows and to ensure that they're not reliant on a really hot summer in order to pay their bills. So yeah, I think it's a really new market, and I think it's something we're just starting to see, but I think that there's starting to be really creative structures that can help enable get these products over the line.
Very nice. All right, maybe a last question, probably more towards Jenny. So the question is, if I'm adding storage to my solar projects, how will OBBB's this new tax credit timeline impact my ability to raise financing on it?
That's a good question in terms of your ability to raise financing. I think if you focus on upfront qualification, if you don't qualify, yeah, obviously it's going to impact probably your financeability. Potentially, if you largely were going to rely on the revenues of the tax credits as well. So I would say focus on upfront qualification for storage before it begins phasing down for 2032. If you're trying to pair solar, then yes, you should definitely focus on qualifying or safe harboring your solar technologies by July 4th of 2026. If you can, by December 31st of this year, the July 4th, 2026. Otherwise, that 2027 cliff kicks in terms of placement and service. And so you want to make sure you're being cognizant of can you qualify for these credits. So I think financeability and qualifying for the credits kind of go hand in hand, unless you're one of the unicorns that did not need tax credit revenue.
All right. Well, with that, Anna, I think this was the conversation that we're hoping to all have here. I'll hand it back over to you.
Thank you so much. Thank you so much, everyone. Once again, thank you, our panelists, Richard, for beautiful moderation. I think it passed for me very quickly. I don't know how about you guys, but I think it was very, very dynamic conversation. And thank you so much, all the attendees who joined and asked so many questions. I think we still have a bunch of them not answered. So some of you passed them anonymously, therefore we cannot reach out to you and answer them. But please feel free to join one of our conferences, meet in person, Richard, Jenny, Philip, and Emma. So we have our upcoming conference in Houston on the 2nd of October, focusing on storage, as well as we have in April 2026 coming up our asset management conference. A lot of you already attended that event. It's our 12th edition coming up. And please sign up for the announcement of the very early bird, which is still not live, so be first to know. We also have right now for our October events, the 15% discount. Try to use it, and this whole information will be shared with you after the webinar along with the recording. But in the meantime, I really appreciate for all your insights. It's been super interesting. Thank you so much, Richard, Jenny, Philip, and Emma. And I wish to everyone have the rest of the day very beautiful and sunny. Thank you. We have some reactions coming on up as well for people.